All right, this first section will cover chart reading. I'm going to go over some basic pointers in this intro that will kind of get you started and help you understand the mindset that you should bring to this section, okay? First, a candle by itself does not mean anything. And you may wonder, well, what does he mean by that? Or maybe you know. But here's a good example. Check out this candle here in the gray box. This candle is a big red candle. The market gaps up, the stock gaps up. In this case, it is the S&P 500. And it falls all day, and it's a pretty big drop, and it closes near the lows. Now, when this happened, I was telling my group and my subscribers that they should not be worried, and the market was still bullish. We got cautious a little bit, but we were not bearish. We were not looking to short the market, and we'll dive deeper into that, but essentially what this means is that the trend is your friend. And so what you'd want to see to actually get short the market is another down day after that, and then some sort of range that forms. If you look over here on the left, you have a similar situation. You have a large run up and you have a big candle, but then the next day you have another big red candle and then a range forms. And we were shorting in here on this drop. Okay, so one candle by itself does not mean anything in either direction. You have to have context, you have to have volume. Okay, we're going to get into all that and how you can actually read one candle by it, in its context, and then understand better what it actually means. Less is more. You'd be surprised, but some traders' charts really look like this. Maybe all of them aren't to this extent, but there's a lot of new traders that come in. They put RSI on their chart. They put MACD on their chart. They put the Ichimoku cloud, the Bollinger Bands. They draw lines and resistances and supports all over the place. They use Fibonacci's. The point is, guys, that these things are completely useless. Every system used by a trader, they all have their own system, and if it works, great. But each trader is likely only going to use a couple of indicators to support their trading. And different indicators can be used for different styles of trading. Not everyone trades the same, and that's an important thing to know. Everyone kind of finds their own style of trading that works for them. Obviously, in this course, I'm going to share with you how I trade and how I look at the market. And if you decide that you like some of it and you want to make some of it your own, then that's fair. The point is, guys, that this is too much and it won't help you. Traders will look for a convergence of 10 different indicators. And they'll say, okay, when all 10 of them line up, I'm going to hit the button. I'm going to get in. And they think because everything's lined up that trade is 100% chance of working. And not only is that not true, but it's barely ever going to happen, and it's completely pointless. Okay, here's an example of what my chart looks like. It's really simple. I use volume-weighted average prices. Those are those blue lines there. And that tells me what the average price paid is from any certain date. And so often when you get a high volume event or you get a change in trend, a significant high or low, I'll put these volume weighted average prices to start from that date and then see how price reacts when it comes back to it. And so if it has a nice healthy bounce or a rejection, then that means that when the average price is come to, people want to buy it. So in this case here, you get this, it's almost a bearish rally, but then you get this gap up here, and it changes the sentiment. All of a sudden, everything starts to go up. This topping pattern here fails. And so I put one here. And every time we've come down to it in the recent months, it's been bought up aggressively. And so what that tells you is the buyers in the market, they wanted to pay fair price. Every time we got to the average price paid from this sentiment shift, buyers stepped in strong numbers and high volume. Okay. This over here, it shows the volume traded at each price. So at this price here, around 300, there's a lot of volume done. All right, that's how this is used. I'll get more into that and how to use it. The point is, guys, it's very simple. It's a moving average and a couple indicators. Okay, and volume. Simple is better in trading. Price pays. Opinions are for furus and paper traders. That's a fake guru and a paper trader, someone that trades fake money. I'm on Twitter, and I can't tell you the amount of people I've seen that constantly post their opinion about the market, whether it's going to crash and fall by 50% in the next year, or whether it's going to go up by 30% the next year. All of the people that say this kind of stuff are full of shit. Okay? Trading is about finding a high probability setup, having a system for taking a loss, taking profits. Opinions about where anything is going to go does not matter. If you're an investor and you like a company and you like their balance sheet and you like the things they do, saying that they're going to go to the moon or go to this price, or that you don't like a company and they're going to go to zero, none of that matters. All you have to do is make that educated decision based on the company fundamentals, right? Same with trading. You find a good setup and you play it, and sometimes it works and sometimes it doesn't. It's a game of probabilities. Price pays. As you can see from my last slide here, I like VWAPs because they do not lie. They don't lie. Without a VWAP on your chart, and I'm going to get more into these and why they're so incredibly important, but without these on your chart, it's a lot easier to create an opinion about what the market is doing or what a stock is doing. If I didn't have this here, and maybe I didn't have the moving average, those are two simple things. The VWAP is moving up, and the 50-day moving average is moving up. So those two things in itself can give you a big picture bullish bias. Even though everyone's freaking out here, before all this happens, I guarantee you people were like, oh my gosh, the market, it's going back to the lows. It's going to crash. We're in a recession. People are dying. This is during COVID if you're not watching during it. But price pays. And with these VWAPs, we can tell that buyers are in control of this market. Okay? Price pays. We're going to go over how to find entry and stop loss levels for short-term trading, for swing trading, how to look at a daily chart, 30-minute chart, 1-minute chart, and how to find those entry spots and how to place stop loss levels at the right areas. A lot of traders mess this up. They get stopped out and it goes on to run without them. Or they set their stop too low or too low, and then they get stopped out for too big of a loss. And so part of that is knowing, okay, where's my entry? And is it a good distance away from where I think my stop loss should be? And do I think I can make 2 or 3 times in profit? Right? If my entry's at $10 and stop loss is at $9, do I think that the stock can get to 12 or 13 or 14? That's a good trade. So that's something to always keep in mind as well, and we'll get into that. Use volume to your advantage. Volume is key. Volume and price pay. That's what it should say, is volume and price pay. Volume, price, and trend pay. Okay? These gray rectangles, they show on the volume by price indicator what areas have a lot of volume done. And you can tell this by the chart here, right? It has a big area of a lot of candles, and so in turn, you would assume that there's a lot of volume done in that area, but this indicator, it really just gives you a better picture. You don't know on these little spikes, like you don't want to have to try to figure out for yourself, okay, well, there's a lot of volume done here, right? So this just makes it easy to view, and it tells you where a lot of volume is done. And so how you can use that to your advantage is using trend and using this volume indicator to your benefit. Another name for these, something, when there's a really long one, or maybe a few like this, and then the market or the stock starts getting towards the top end, and you see a candle like this, or maybe it comes up and it starts holding over that volume area. What that's telling you is that there's a lot of volume down here, and maybe there's short sellers in here. And then you get up here, and so when you're coming down and you see wicks, and it's not getting back into that volume area, it's telling you that maybe shorts are covering, maybe more buyers are now attracted. And so that's a good way that you can use an entry signal in your strategy when something's breaking out of a volume shelf like this. And so this is a trade, this is FUV, the ticker FUV, and this is a trade I actually entered today. So we'll see how it goes, but it's great. The trend is up. We have another nice volume area here, and it's pretty well defined by this range. And as well, this is what I look at down here. Where's the most volume done? Are there volume patterns of accumulation, of strong buying, or are there volume patterns of more of a squeeze, right? So this is a low price stock. So a lot of bad companies, they'll sometimes experience these large moves, like penny stocks. Maybe you know about them. They'll experience these large moves, but immediately after, a day or two after, or sometimes a long time after, they'll have really high volume selling days. And so this is another key thing that I look for. One thing you can call it is a power earnings gap. So a lot of times companies will have earnings. Maybe they'll be in some, trading like this. And then all of a sudden, they'll have a big gap up, and maybe they'll close like on the high of the day, or they'll close really well. Basically, they hold the gap very well. What this usually, and on large volume like this, it's not always going to be this much larger, but larger than normal. And what this is going to tell you, that something in the earnings meeting, the market really liked. You don't necessarily have to know what it is, but the market really liked something. And that's all. You can just look at that candle, look at the volume, understand these volume patterns, and you'll know that. And so from then on, that can be a chart that you can look for nice continuation setups in. And so just because I see this doesn't mean I enter up here. I wait. It's a nice low volume pullback, so it's not strong selling. It's just what you want to see. And then boom, you see another pretty good volume spike here, right on this candle. And it's like, okay, this is looking better, right? We've put in a low and we've put in a nice reversal on nice volume. And then I've waited for it to get, rest a little bit more. And today it finally broke above the top of this range here. And so, we've taken a position in this, and we'll see how it goes. But these are some examples, guys, of how you can use volume to your advantage. We're going to get even deeper into this, go over a lot of charts so you can get some good examples. And so, yeah, that's a quick overview of the charting that we're going to learn. We're going to go over other stuff like trend identification, supply and demand, inflection points. Okay, we're going to go over a lot of other stuff. So hopefully that gives you some good pointers and stuff you can be thinking of and working on identifying. All right, see you in the next one.